Welcome to the Barnes Report's 2026 United States Economic Forecast video. Foreign trade deals, an AI-driven productivity wave, and lower interest rates will strengthen the United States economy in 2026. Barnes Reports is forecasting a stronger U.S. economy in the next few years than many other economists based on these factors. Many economists are more pessimistic about the U.S. economy, citing tariff uncertainties, and that these tariffs will drive higher inflation. We'll explore all these issues in this video. Barnes Reports is a leading market research firm located in Bonita Springs, Florida. Established in 1998, Barnes Reports publishes thousands of global and U.S. industry and market reports annually. The U.S. economy is forecasted to exhibit moderate but steady growth over 2025 through 2027, with GDP rising approximately 2.5% in 2025, then incrementally increasing to 2.6% in 2026 and 2.7% in 2027. This gradual acceleration reflects a resilient economic recovery driven by technology investment, sustained consumer spending, and easing inflationary pressures. Lower trade barriers and incremental Federal Reserve rate cuts are anticipated to support business investment and labor markets. While growth is steady, it remains below historical boom periods, reflecting challenges such as an aging workforce and global uncertainties, balanced by gains in productivity, particularly from AI and digital transformation. The positive drivers for the U.S. economy for 2026 include AI-driven productivity, a resilient labor market, and lower interest rates. AI-driven productivity and investment boom. Optimistic forecasts see continued, robust investment in artificial intelligence infrastructure and related technologies, which began in 2024 and is expected to continue for the foreseeable future. Resilient labor market and healthy consumer spending. Optimistic projections cite persistent job growth, stable or falling unemployment rates, and real wage gains, which fuel strong consumer spending. Recent data revisions have revealed higher than expected personal incomes, which are expected to reinforce consumption growth despite higher interest rates and global headwinds. Easing monetary policy. Optimists expect lower borrowing costs to support renewed business investment, housing market stabilization, and economic resilience through 2026. The restraints and threats to the U.S. economy for 2026 include tariff uncertainty and higher inflation. U.S. tariffs negatively impact the economy by raising costs for businesses and consumers, leading to higher prices for imported goods and for domestic products that use imported components. Tariffs reduce overall trade, slow economic growth, and lower household income, with studies estimating an average annual loss of $1,500 to $1,800 per household. Widespread tariffs also disrupt supply chains and decrease business investment, raising the risk of job losses and stunted productivity. For inflation, tariffs have directly contributed to headline price increases, explaining as much as 10% of recent inflation, by raising the prices of essential goods and raw materials. A significant positive factor in the U.S. economy is the numerous new trade deals the current administration has inked. President Trump and his financial advisors have led a campaign to bring foreign investment from both governments and corporations into the United States. These trade deals should increase corporate and government revenues over the next few years. These deals include a $600 billion commitment from Saudi Arabia. President Trump announced that Saudi Arabia had committed to invest $600 billion in the United States. This was positioned as a significant win during his Middle East tour, with a focus on deepening economic ties and supporting innovation and job growth in both countries. Qatar made a headline commitment of $1 trillion in an economic exchange agreement, which includes investment in the U.S. and commercial and defense deals. While this figure covers both direct investment and trade activity, it reflects a significant diplomatic achievement touted by the administration. Major technology firms, including Amazon, Microsoft, Alphabet, and Meta, together pledged $300 billion in investment, with a particular focus on U.S. semiconductor manufacturing and AI infrastructure. This wave of investment highlights technology leadership as a key target of foreign capital inflows. Trump's 2025 negotiations included $200 billion in deals between the United States and the UAE, encompassing a range of commercial partnerships aimed at bolstering American manufacturing and service exports. In October 2025, Japan committed to investing $550 billion in various sectors of the U.S. economy, including energy infrastructure, critical minerals, and advanced technology projects. The United States unemployment rate remains low, hovering around 4.3% as of August 2025, due to steady jobs growth in key sectors, ongoing consumer demand, and resilient business investment. Despite global challenges and interest rate pressures, companies have continued to hire, supported by technological advancements and productivity improvements. Healthy labor force participation, wage growth, and strong service and healthcare sectors help offset losses elsewhere. The continued economic recovery after the pandemic and aggressive monetary and fiscal support policies have further stabilized the labor market, keeping overall joblessness at historic lows. There is disagreement over the Trump administration's use of tariffs. If the U.S. economy begins to slow, President Trump is likely to reconsider his high tariffs, as they have direct and indirect economic costs that magnify downturns. Tariffs increase costs for businesses and consumers, reduce supply chain efficiency, and raise prices, thereby dampening consumer spending and undermining corporate investment. During a slowdown, the need to boost growth and restore consumer confidence would incentivize Trump to lower or suspend tariffs to revive export activity and mitigate recessionary pressures. While President Trump's use of tariffs is to create equitable trade barriers with countries that have had tariffs on American goods for decades, and move U.S. imports from opponent countries, such as China, to imports from ally countries, he has shown flexibility to change tariff policies quickly based on new economic factors, since a strong economy is his highest priority. U.S. interest rates are expected to decline from the current 4% to historical lows due to easing inflation pressures and perceived economic uncertainty. The Federal Reserve has already begun cutting rates in response to economic uncertainties, aiming to sustain economic growth without overheating. Lower inflation provides room for more accommodative monetary policy, which helps reduce borrowing costs for businesses and consumers. Additionally, the Fed plans to end its quantitative tightening program by reinvesting proceeds from maturing short-term securities, further supporting lower long-term rates. For more 2026 economic forecasts, please visit www.barnesreports.com and subscribe to this channel. We'll be highlighting economic forecasts on global economies and major industries weekly so that you can make accurate business plans for the following year.